Section 17.2 is taking a look at calculating earning performance and efficiency analysis. We have to understand in Section 17.2 the accounting concept of going concern. Basically, that means the business is going to go through and complete all work with the expectation that it'll be remain in operation indefinitely. What does that mean? Basically, if the business purchases a computer today and the computer has a life expectancy of 5 years, based on depreciation, it can be calculated on the computer's life. So even though the company may intend to sell the business in 2 years when she retires, they're not going to base that depreciation on 2, they're going to base it on 5 years. So a company must continue to operate. Its earnings must maintain a satisfactory level. The Hamilton Corporation measures its success by calculating 5 earning performance ratios. The 5 earning performance ratios that we're going to be taking a look at is rate earned on average total assets, rate earned on average stockholders' equity, rate earned on net sales, earnings per share, price earnings ratio. The other thing that we're going to look at in 17.2 is also going to be taking a look at ways that businesses become more efficient. So let's take a look at first our rate earned on average total assets. When we take a look at companies are going to invest large sum of money in assets. We purchase inventory, buy computers, or accumulate accounts receivable. Businesses need these assets to help them earn a net income. But we must make sure that the company uses those assets efficiently in order to earn that income. One way we can do that is to determine its rate earned on average total assets. We're going to compare the rate earned on average total assets with the rate earned that can be earned on other investments. For example, if a company can earn more money by placing cash in a special savings account, then maybe we need to take a look at how the company needs to reevaluate its earnings goal. So let's go through and see how we calculate our rate earned on average total assets. So we have to take our January 1st total assets plus our December 31st assets, divide by 2. That makes sense. Those are 2 assets and numbers. We have our January 1st number and we have our December 31st number because we go through and prepare a balance sheet. This January 1st number is going to be the number on our December 31st of the prior year, and this will be the one on this current year. So we take those 2 numbers for our Hamilton Corporation, divide by 2, and it gives me my average total assets of $1,913,700. So what do I do with that? Well, I have to go through and take a look at what my net income after federal income tax is going to be. So my net income after my federal income tax, $220,300, divided by my average total assets, gives me a rate earned on average total assets of 11.6%. So what does that mean? Well, what did we do the previous year? So when we look in our book on page 504, you're going to see that on our previous year, we had a rate earned on average total assets of 8%. So Hamilton's available investment resources earnings are at 10%. So the previous year fell below that goal. So when we take a look at what happened this year, we improved because we went up from 8.0% to 11.6%. Therefore, they believe that the rate earned on total assets of 11.6 is satisfactory. Again, they had an option of other investments of 10%, so they wanted to make sure that this rate earned on average total assets is greater than that 10%, and then they would have made a smart financial choice there. So, rate earned on average total assets. Let's take a look at our rate earned on average stockholders' equity. I didn't click enough when I was explaining the last one. So we'll take a look at what are liabilities. Okay, liabilities basically are funds that are invested by creditors And stockholders' equity are represented by the owner's worth in investments in the corporation. We need to realize that investors or stockholders are very interested in knowing the amount of net income their investment is going to return. So we're going to calculate our rate of return earnings on average stockholders' equity. We're going to compare the rates of several businesses in order to select the best investment. So we have money, we want to make more money. What do? We look at businesses to invest in. So we can compare these rates to see which one we think is going to be the best. So how do we calculate it? We take our January 1st stockholders' equity, December 31st, divide by 2. It gives me my average. From there, then I'm going to take my net income after federal income tax. This sounds familiar. It's what we did last time. And we can see we have a rate earned on average stockholders' equity of 23.4. Again, investors compare the rate earned on stockholders' equity for several businesses to determine the best investment. We increased from the prior year because the prior year we had a rate earned on average stockholders' equity of 15.4, but now we have 23.4. So based on the trend and the comparison with industry standards, we have achieved a satisfactory rate on earnings for our average stockholders' equity. What does that mean? We're doing well. Rate earned on net sales. This is going to measure the profitability the company is properly managing the cost and expenses incurred to generate revenue. We need to realize that when this rate declines, it means the company is spending a greater portion of every sales dollar received on cost and expenses. We have a vocabulary term in this section that says rate earned on net sales, and that is found by dividing the net income after federal income tax by the net sales. So how do we go through and do this? So we're going to take a look at our net income after federal income tax. Divide by our net sales is going to give us our rate earned. Okay, our 4.7. Hamilton's rate on net sales of 3.5 in the prior year was unsatisfactory. So this 3.5. The rate and trend earned this year, 4.7, is a satisfactory rate. This trend should be watched closely because we need to watch for declines because the company must increase sales or reduce costs to maintain an acceptable rate. We always go through and determine what an acceptable rate is based on net sales. Hamilton considers what is normal for similar businesses and the company's own past expenses. So the businesses similar to Hamilton's have been earning 4%. That's why I said that last year or the prior year where 3.5 was unacceptable, but this year 4.7 is acceptable. Earnings per share is the most commonly used measure of a firm's profitability. The amount of net income earned is divided by the share of common stock. What's going to happen to a price of stock if the earnings per share is steadily increasing? Well, the stock will probably increase. If a company consistently improves its earnings per share, demand for the stock will increase, thus driving the price of the stock upward. A positive trend in earnings per share generally indicates that the company is being managed well. The price of the stock increases and it becomes easier to sell stock or to borrow money for the company. So how do we calculate this? We're going to take our net income after federal income tax and divide by our total shares of stock outstanding, 60,000 for our current year, which gives us our earnings per share for this year of $3.71. A positive trend is important to our company. So previous year we had our earnings per share of 2.57. So going up to 3.71 is very favorable for Hamilton Company. We want to take a look at our price earnings ratio, or PE ratio, it also can be referred to. The PE ratio shows the relationship between the market value per share and the earnings per share of stock. A high PE ratio means that investors expect high growth and high earnings for the future. The price earnings ratio is often reported in the stock market section of a newspaper. So let's go through and calculate this. So we have to take our market price per share and divide by our earnings per share. So our market price per share is going to be stated what it can be sold for, and that's $43.50. Earnings per share we just calculated before, and that was 3.71. And we calculated that again by taking our net income after federal income tax and divide by our shares of capital stock outstanding. When we divide these two, we get a price earnings ratio of 11.7 times. So a single share of stock is selling for 11.7 times a single shares of earning. So prior year, when we took a look at it, we had a price earnings per share of 2.57, and the market price per share of our stock was $24.50. So we can see that this year our business is doing much better because we increased from 9.5 to 11.7. And indicates that the investors consider the stock more valuable and were willing to pay more for the stock per dollar earned by the corporation than the current year. Basically, good news for Hamilton. So the next thing we're going to take a look at is our efficiency analysis. How well are we doing things? So we have to take a look at our efficiency analysis is going to take a look at the operating cycle of our business, and it consists of 3 phases: purchase merchandise, sell merchandise, collect accounts receivables. When we take a look, we have to look at each one of these sections to see how efficient we are doing. So we're going to take a look at first how we're doing with our accounts receivable ratio. So why should businesses allow customers to buy an account? What are our advantages? What are our disadvantages? We know that there are some disadvantages, but basically one of our first ones is when we have money invested in accounts receivable, it does not earn income. So for example, you're a customer, you come buy from me, but you don't pay me cash. You take 30 days to pay. It's 30 days where I don't have that product to sell and I don't have that cash in my pocket. That's a disadvantage. The other thing that I have is I have some sassy people that I'm not going to be able to collect from. That means less cash to pay some expenses. So you came and bought from me, but you ended up not paying. That's going to cause a problem. Okay. So what are some advantages? Well, it can encourage greater sales, thus net income. We also have customers that lack cash may still purchase items. It allows customers to make monthly payments and may encourage the sale of merchandise with high ticket prices. So for example, taking a look at a car, what if you could only buy a car if you had all the cash right now? That might not work out too well for everyone. And it also allows customers to purchase items in times of emergencies. So if we know the products we're selling might fit those needs, that would be some of the reasons why we would do that. Accounts receivable should be collected in a timely manner. The accounts receivable turnover ratio measures the number of times the average amount of accounts receivable is collected annually. We do this by calculating it but using our net sales on an account figure. So net sales, we have to remember what net sales is. You have to take out your discounts and your returns and allowances on that. So we take our beginning value of accounts receivable plus our ending book value of accounts receivable, divide by 2. That gives me my average. Then I have to take my net sales on an account, divide by the average number we just calculated. And our net sales on account would be a number they would give to us. So we therefore have an accounts turnover ratio of 9.1. So what does 9.1 mean? Well, what are we going to do with that? Great, 9.1. How do I measure that? So we're going to take that and figure out what that means. So there are 365 days in the year, and we're going to divide that by our accounts receivable turnover ratio. So when I do that, that gives me 40 days. So what does that mean? That they have accounts receivable are paid off once in every 40 days. What do we think? Is a high turnover ratio favorable or unfavorable? When we have a high turnover ratio, the fewer number of days required to collect your accounts receivable. So therefore, a high turnover ratio is going to be favorable. When we take a look at what they had last year, okay, last year for our Hamilton company, they had an accounts receivable turnover ratio of 7.0. And if I take 365 divide by 7.0, that's going to give me 52 days. So they decreased the average number of days of payment from 52 to 40. That is more money in our business. Is that making us more efficient? I would say yes, it is. The other thing that we want to take a look at is going to be our merchandise inventory turnover ratio, which again is going through and taking a look at how fast our business is turning over our items on our shelves. So we have to take and calculate our average merchandise inventory, add the two numbers together, divide by 2. It gives me my average merchandise inventory. With that, I have to take my cost of merchandise sold, divide by my average merchandise inventory, and that's going to give me my ratio. And I have a ratio this year of 5.4. Okay, that means that the inventory is being sold 5.4 times in a year. So let's take a look at what does that mean for days. The average number of days sales in merchandise inventory is 68 days. 365 divided by our turnover ratio of 5.4. Last year, Hamilton had a turnover ratio of 66.2 times, resulting in the average number of days in merchandise inventory of 59. So, what is an optimum merchandise inventory turnover ratio? Well, it's determined by two factors: the amount of sales and the number of days needed to replenish inventory. We know for Hamilton that it needs to maintain an inventory ratio of 6.0. This 6.0 ratio indicates that average number of days the sales merchandise is 61 days. However, last year's Hamilton sales and inventory is 59. This is lower than desirable, and inventory resulted in lost sales because some items were out of stock before new inventory. When we take a look at our current year inventory, 60 days, it is satisfactory because that means we don't have customers going to our shelves and we having everything left blank. So that's good news for our business. So far we can see we have a positive trend going on for Hamilton Corporation. And that is our vocabulary term. So we have a lot of formulas that we need to go through here in section 17-2. So looking at our work together, we have to calculate the following earning performance and a ratio for the current year. Round our calculations to the nearest 0.1%. Dollar amounts need to be the nearest 0.1 cent, and price earning ratios to the nearest tenth. So the first thing we have to do is our rate earned on average total assets. So I'm taking a look at right here. I'm going to go A, B, C, D all the way down. Rate earned on average total assets. So let's get our formula. January 1st total assets, December 31st total assets divided by 2 is going to give me my average total assets. So what is my number here for January 1st total assets? That's going to be 4,600,000. My December 31st total assets is going to be listed here, 5,300,000. Divide by 2. Take your calculator out. That should give you your average total assets of 4,950,000. Second part of our formula is our net income after federal income tax divided by my average total assets will give me my rate earned on average total assets. So my net income on federal income tax, well, let's see where I find it. Well, right there, 530,000. My average total assets, what I just calculated, divide those two with your handy dandy calculator, and that should give you 10.7%. So number A is done. Rate earned on average total assets. Now I have to take a look at the rate earned on average stockholders' equity. So I have to do the same thing. January 1st stockholders' equity, December 31st divided by 2 is going to give my average stockholders' equity. Okay, use my numbers right here. Plug that into my calculator, which gives me my average stockholders' equity, 700,000. Second portion, my net income after federal income tax divided by my average stockholders' equity gives me my rate earned on average stockholders' equity. My net income is still the same number, 530. Average stockholders' equity, 2,700,000. My rate earned is going to be then, plugging that into my calculator, 19.6%. My third formula is going to be my rate earned on net sales. So it has to be my net income after federal income tax divided by my net sales, which will give me my rate earned on net sales. Net income after federal income tax, familiar number, I've used that a lot, 530,000. My net sales is going to be 5,760,000. My rate earned on net sales, plugging that in my calculator, is going to be 9.2%. I said 2 and typed 5, 9.2%. Earnings per share. Net income after federal income tax. Shares of stock outstanding is going to give me my rate. It's going to give me my earnings per share. I was off. Okay, 530,000. Shares of stock outstanding should be 100,000 right there. Divide those two, I get 5.3. price earning ratio is my market price per share divided by my earnings per share, price earnings ratio. Market price per share right here, the share of stock is selling for $52.50. Earnings per share is 5.30. My price earning ratio is 9.9 times. Now I'm getting into my efficiency calculation, so my accounts receivable turnover ratio. How often am I getting my clients or my customers to pay off their bills? So I have my January 1st, December 31st. It's going to give me my average. So we have to find those numbers. So my January 1st accounts receivable is going to be $630,000. December 31st, which you see right here, it's going to be $710. Divide by 2, plug that in your calculator, which gives me an average book value of accounts receivable of $670,000. The rest of the formula, we go through and take a look at my net sales on an account, my average book value of accounts receivable will give me my average receivable turnover ratio. Net sales on account, turnover ratio of 8.6. How many days does that take? Well, days in the year. Accounts receivable turnover ratio, average number of days for payment. So days in the year, we have 365. Turnover ratio of 8.6. Average number of days, 42. Well, okay, the turnover ratio gets a little bit hard to understand how well it works. But number of days of payment. If they say their terms are 210 net 30, that means all of their customers should be paying their bills in 30 days. But the average number of days is 42. They might want to take a look at lowering that a little bit. But again, we don't have the information here on what their terms are, but a lot of them are 30 days for being able to be due. So now we're on calculating our merchandise inventory turnover ratio. So we have to start with our January 1st merchandise inventory plus our December 31st divided by 2 is going to give me my average merchandise inventory. So here we have our numbers here for merchandise inventory. One is 500,000. The next one is 525,000. Divide by 2, which gives me an average. I plugged the wrong number in there, sorry, 550,000, which gives me the average of 525,000. Okay, I need to plug those two numbers in there. So now I'm going to take my cost of merchandise sold, divide by my average merchandise inventory. It's going to give me my merchandise inventory turnover ratio. Cost of merchandise sold is stated as $3,810,100. 3,810,000. I can say the right number. Average merchandise inventory 525,000. Turnover ratio of 7.3. Okay, well, how many days does that mean? Days in the year. Merchandise inventory turnover ratio. And again, we don't have the information for this business to know what they need for time to turn over to be able to view, but we certainly have these numbers plugged in for our formulas.